Welcome everybody to the February 2023 monthly video series. My name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. As we do every month, I want to spend some time just going through a hot button issue or topic or some sort of item from markets or portfolios that seems to be top of mind for most investors at that given time. This month, I want to spend a few minutes going through ways to reduce portfolio volatility or portfolio risk. So when we say reducing risk or the risk within a portfolio, really what we're referring to is the volatility of a portfolio. But I want to spend a few minutes walking through ways that you can reduce portfolio volatility, both at the overall portfolio and then even just within specific portions of your portfolio. So kind of when we summarize kind of the main ways that investors will do this, one, the good old-fashioned diversification, right? It's just the old adage, don't put all of your eggs in a single basket. We'll talk a little bit about why it's such an important concept within investing. But that's something that many investors use, most investors should use diversification. Another way is using within your equity portfolio or your stock portfolio is using specific types of businesses to reduce the volatility. They can be what are called lower beta, more defensive, or even reweighting your portfolio into some sort of minimum volatility factor tilt. And we'll talk a little bit about what each of those means here in a few. And then the other way we often see investors doing this is maybe more synthetically with derivatives. One way you can do it is through the use of options, right? You can either buy something called a put option, or you can use an options collar within your portfolio, which is actually something we've used traditionally during times of trying to reduce portfolio volatility. But we can talk about that here shortly as well. So let's just jump into diversification, right? This is the most basic building block from our perspective. This is a foundational investment principle, if you will, of what most investors should do, right? And diversification, all it is spreading your assets amongst many different asset classes that are less correlated with each other. What that means is they don't move perfectly in tandem with each other. So when one zigs, some may zag, right? Typically that is always talked about within the confines of stocks and bonds. 2022 wasn't exactly a great example of that, but traditionally during market downturns, when stocks fall, bonds will hold up well, if not be positive. That uncorrelated principle allows your portfolio to have a smoother ride and to reduce that volatility. You can also do this within the portions of your portfolio, US stocks and emerging market stocks, right? So you think about US large cap companies and businesses from China. You can own both, and they are affected by slightly different factors, right? There's some similarities within the global growth conversation or global demand conversation, but they're going to have different factors, whether it be foreign exchange or domestic policy or things like that. They're not going to move perfectly in tandem. So many investors think when you spread your assets around that you're reducing your expected return, and that's not necessarily the case. If US equities and emerging market equities have the same expected return over time and they're uncorrelated, you can keep your return expectation the same, but reduce your volatility compared to if you held US equities or emerging market equities by themselves. It's just math, right? So diversification is mostly just math. It's a way to manipulate your risk tolerance. It's a way to have a more efficient portfolio. And what we mean by that is have a better risk-adjusted return. If I can get the same return for less risk, that's just a more efficient way to go about it. That's what we're all striving for, because all financial assets have some sort of risk inherent to them. But if we can minimize our risk by diversifying, this is the most basic principle and a way to reduce your portfolio volatility. If we kind of turn our attention more towards the equity side specifically, we can actually buy stocks that have properties that are more defensive, right? Or what we call low beta, right? So if the market's up 10%, they may only be up 7, 8%. Or on the flip side, if markets are down, if the broad market's down 10, they may only be down 7 or 8% or something along those lines. That's just what we would call lower beta. Oftentimes what you find is you can target businesses like this within certain sectors, right? So there are just certain sectors that major rating agencies like Morningstar will classify as defensive sectors. Traditionally, these have been consumer staples, utilities, and a lot of healthcare businesses as well. Right? These are businesses that are just not cyclical. They're not reliant on the strength or the weakness of the economy to perform well. They're just businesses. Utility businesses are what they are. People use utilities regardless of the strength of the economy. So you can lean your portfolio to those areas. You can also use something nowadays called minimum volatility factor investing. So really what that does is it takes a portfolio, instead of market cap weighting, which all that means is weighting your portfolio by the biggest company to the smallest company. Instead, let's reweight that portfolio by the least volatile stocks to the most volatile stocks. So the highest weighted stocks are going to be the least volatile. Just another way to target specific types of businesses. So that's another thing you can do within your equity portfolio, is to target specific sectors, types of businesses, or kind of what we would call factors, right? One of them being minimum volatility or low volatility. And then lastly is probably the most complex thing, and we don't need to go through the details of how options work, but you can use more synthetic derivatives within your portfolio. Two of which would be something along the lines of a put option. So you can go buy a put option. Really all that means is you buy something that you not expect or you want to protect if it falls below a certain point. It gives you the option to sell it at a price and where you expect it to actually fall below that price. Just a way to protect your portfolio. However, buying a put option costs money, right? So there is a cost related to going ahead and adding that position to your portfolio. Another way to do it, and what you see on the screen, is what's called a collar strategy. It is when you buy that same put option, right, to protect on the downside, so you see your downside is limited. But what you do is you sell a call option, which means you're essentially limiting your upside. All you're doing is giving yourself a defined space where your return will fall. A lot of times this is helpful when you expect markets to be either flat or down. But this is a good way to protect your portfolio. It's actually something we've looked at in our portfolios and we have utilized in our portfolios at times when we are going more risk off, right? We expect markets to be choppy. We'll add something like this within our equity portfolios just to add some extra layer of protection within the portfolio. So in summary, if you think about the different levels, and there are more to this, but if you think about the major ways of reducing your volatility, you just start with diversification. You can be an all equity investor, an all stock investor, but you can still diversify and have a more efficient portfolio. Take a step further, add fixed income, cash, and within bonds, you can look at treasuries and mortgage-backed securities and corporate bonds. Diversifying your portfolio is just an efficient mathematical way to reduce the volatility within your portfolio. Within stocks, you can target certain types of businesses, low beta, more defensive sectors, or you can reweight it, be more creative with a minimum volatility type factor investing style within your equity portfolio. And then lastly, you can go to the options market, right? Be more derivative focused, buy a put option, which just does cost money, right? So there is a downside to it, but obviously you are doing it for the purpose of protecting your portfolio. Or do some sort of strategy with the options collar, which is nice because you would sell a call option on the other side. So you limit your upside, but you offset the two costs. So it's really kind of costless, or could be costless. And really what the cost is that you kind of limit your upside, but you protect your downside. But it's a synthetic way to at times add and hedge your risk within your portfolio. So I hope this was helpful. At Diversified, we're looking at all these different types of strategies. Diversification is naturally a basic foundational principle of what we believe. But other things like the lower beta or the hedged equity type strategies are things that we'll look at and we do implement within our portfolios at certain times when we want to reduce the volatility within specifically our stock portfolio. But I hope this was helpful. But as always, if you have any questions, you can reach on out to us here at Diversified. We're thankful for your business. We're thankful for your partnership. And until March, we'll talk soon. Take care.